Thanks for coming. I'm glad that Dean laid out the basics of the crisis here. One of the reasons we decided to have this event is because the IMF, which has been looking for a new mission since the Bretton Woods system collapsed in 1973, that was their original mission, was to, from 1944, was to maintain this system of fixed exchange rate. And that disappeared in 1973, and ever since then they've been looking for other things to do. And so with the onset of the crisis, they've been saying, well, perhaps we should become the new regulator of global finance. And something to be taken seriously because they still have a certain amount of clout in the world, although it's greatly diminished, and they could play a very significant role in the near future. So that's so I'm going to look at that aspect of it, and so and then I want to make a couple of other points that I think are important to the present situation. But so I just organized this with apologies to David Letterman as the top 10 reasons why the IMF should take the lead in the reform of global finance. And let's start with number 10. Okay, they missed the two biggest asset bubbles in the history of the world. And you go through, the World Economic Outlook comes out twice a year. And if you go through the last 6 years or 10 years, whatever one, you don't really see much. There was a couple sections they wrote on the stock market bubble and said that that's not really a problem. We're not sure if it really exists. And then they had one issue a few years back where they said a little bit about possible housing bubble, but then never said anything about it again as the bubble continued to explode. Now, Dean already showed you the home prices graph. Here's one for the stock market bubble. So you can see these things were pretty visible. This little thing there, that was 1929, the price to earnings ratio, which is a measure of the value of stocks relative to either, to their earnings, either presently or forward or trend. And you can see that they really kind of went off the charts there in the late 90s. And Dean was the first and really the only economist in the U.S. to show arithmetically that these stock prices were not compatible with any plausible projections for growth of the economy, because stock prices are related to economic growth. And so they should have either been able to look at the graph or understand the arithmetic. And I might add that their budget is about, last I looked, although it's being cut now, 1,000 times the size of CPER's. So it's kind of their job to notice these things. What's the World Economic Outlook if you're going to miss the biggest asset bubbles in the history of the world? And not a good sign. The IMF is unaccountable. My favorite story about that was a chief economist in the IMF was here talking to NGOs a few years ago, and he was getting annoyed, and he said, I don't understand why all these NGOs are saying we're not accountable. Everything we do, we clear with Treasury first. Which would be fine, except there's 184 other countries in the organization. Developing countries have no significant say in the IMF decisions. And there's been a movement, as some of the people in the audience know, to try and change this for many years. And they finally had some success. This was before the reforms. Now this is a little misleading. I mean, you see the United States with 17% of the vote. First of all, that's enough to veto a lot of major decisions. But second of all, they don't vote in the executive board. Out of 2,000 decisions, when we asked them a few years back, they had made the executive board and only voted 12 times. So they reach a kind of consensus, and it's a kind of a G1 consensus, as we say in Washington. And that's, it's just, that'd be a long story to explain how that is, but it really is a lot of it's just, that's the way the IMF was set up in 1944, and it hasn't really changed. Now, they did change some. You can see this next pie chart. Oh, it looks very similar. The United States lost a half a point. And China, which is the second largest economy in the world, and has, 1.3 billion people, they went from 2.9 to 3.6% in voting shares. And that was the biggest change that was made. And people fought for this for, as far back as I can remember, since I've been in Washington, 10, 15 years. And they, so I figured at this rate, sometime a couple of centuries from now, developing countries will have a voice, but hopefully by that time they'll be high-income countries. The IMF is the head of a creditors cartel that has pressured developing countries to adopt harmful policies over the last 3 decades. We'll look at this a little bit more, and of course we can spend a long time discussing this. But just so you know, the way it has worked, and unfortunately still works in the poorest countries, is that it's not that the IMF itself is such a powerful institution or a huge lender. The power has come from an informal arrangement by which countries have a choice, and very often we're presented with a choice, where if they can agree to the IMF conditions on an IMF agreement, whether it's a short-term standby arrangement or a longer-term poverty reduction and growth facility, and they can, if they don't agree, very often what has happened is, very often, is they wouldn't get credit from the World Bank or other multilateral institutions or the G7 governments, and in the past even sometimes the private sector. So that gave them a lot of power to implement policies which haven't turned out all that well. Here's some that didn't turn out all that well. The IMF made a mess in the last set of financial and economic crises, which it, by the way, didn't anticipate either. And so it isn't just the U.S. where they missed the stock market and the housing bubble. And it says, go through a little bit of this. Argentina, let's see. There's the drop in GDP during the recession of 1998 to 2002 in Argentina. Oh, sorry, it's the Asian crisis first. There's the drop in Argentina, and it was a huge drop, the worst recession they've had in probably the history of the country. And this was a recession that was brought on by a set and exacerbated by a set of policies that the IMF insisted on and supported. Now they, in retrospect, they say, well, we didn't tell them what to do. Of course, it's hard to say that. It's hard to believe that when they can't really have it both ways. You loan them billions of dollars, tens of billions of dollars, you sign off on the policy. So you either agreed with them or you're giving them money to do the opposite of what you want. But in any case, the policies were a failure. The fixed exchange rate, the overvalued fixed exchange rate, that collapsed. And then they came in. That was the kind of the center of the bad policy. And then they just insisted on austerity measures. And then the whole thing collapsed, and the economy collapsed at the end of 2001. And then, here's another failure as an institution. They were supposed to be some kind of lender of last resort. I mean, they were willing to pour in tens of billions of dollars to support this completely inevitable collapse, to support the policy that led to an inevitable collapse. But once the economy collapsed, they didn't really give them anything at all. There was no net, in fact, there was a net drain of about $4 billion out of the country to the IMF and the other international financial institutions, and most of it to the IMF. And that was like 4% of GDP. So they didn't help. They helped create the crisis. They made it worse. They attached a bunch of unpalatable conditions, which the country was smart enough to reject. And look, they got rid of the IMF, and look at the growth they've had. 3 months the economy contracted, and then has grown about 60% since then. And so they were much better off when the IMF finally went away. They had to pay them, unfortunately, $10 billion to go away completely. And they still didn't go away completely, because then there's the Paris Club, which they just now, a month or two ago, a few weeks ago, they agreed to pay off the Paris Club, so they really have the IMF have no more influence. Okay. The Asian crisis was another disaster the IMF was heavily involved in. This is an economic crisis. Both these crises had some similarities with the one that we're facing today, although they're different. And it's nice to know that the Treasury, by the way, is so flexible today in the United States to allow the largest nationalization in the history of the world. Fannie Mac, the largest transfer of debt, the nationalization of the largest insurance company, the extending deposit insurance, the $3.4 trillion worth of money market mutual fund deposits, which were not previously insured. These were important and necessary things, but not what they told these other countries to do. And that, of course, was a big theme at the 63rd meeting of the General Assembly a couple of weeks ago at the United Nations. People were making jokes at various world leaders about socialism in the United States and so on. And in these countries, they had kind of merciless things. You can see Indonesia had the worst drop and the slowest recovery during the Asian financial crisis. And they were telling them to, first of all, they had raised interest rates, which was rather devastating at the time of recession, especially there where the corporations had a much higher debt-to-equity ratio than the United States. They were telling them to meet inflation targets, which were impossible considering how far the currencies had fallen. Indonesia, for example, currency fell by 80%. They were expecting them to hold inflation at 5.2%, from 4.2% before the crash of the currency. So they were really giving them policies that were that made the situation worse. I think pretty much most people agree on that now. And you know, it's kind of fascinating. It shows the really power of the media and how different it is when the crisis comes home. Because now you have a front page article in the New York Times today about revisiting the legacy of Alan Greenspan, who supported all this financial deregulation and the proliferation of derivatives that also went all over the world. And still, you know, and now they're saying, well, maybe he wasn't so right after all, so great. But during the Asian crisis, you can't see this, but it's in the Times, this little Time magazine cover, the Committee to Save the World of Alan Greenspan, Bob Rubin, and Larry Summers. Bob Rubin and Larry Summers being the ones who went out to Asia and set the terms for their for the resolution of that crisis. And you know, it devastated their economies. And what happened? Well, I mean, it did somewhat injure the reputation of the IMF, but not the Committee to Save the World, okay? And so now the Committee to Save the World is going to get a little bit of a reevaluation, we hope. But who knows? So that's the Asian and the Argentine crisis. I could go on. I mean, I mentioned Russia in there, but you know that one was totally ignored really by the media. So that was one of the worst calamities without a natural disaster in the history of the world. They lost about 33% of GDP at least between 92 and 96, 97, and that was that was another IMF program. So IMF has shown no serious efforts at reform despite repeated failures. I'm happy if there's anybody from the IMF in the audience with two companies, please tell me that I'm wrong. I would love to hear it. The IMF's economic projections can be way off target, maybe politically influenced. Here's a good one. This is Argentina, and all you really have to look at is the right column on the right, which has how far they were off on GDP growth. Now, you notice they were off in the big positive direction when they were managing the recession between 1998 and 2002. These are projections made by the IMF just in the fall of the year before we're talking about. So 1999, they make projection for 2000. How does it come up? Off by 2.3, off by 8.1, off by 13.5 the next year. Then the Argentina started doing all the things they didn't want. They defaulted on their debt. They took a hard line against the creditors while the IMF was pressuring them to pay more. They froze utility prices. They did all these things the IMF was quite upset about, and that's why they didn't give them money. Then the IMF seems to be off in the other direction, off by negative 7.8. then 5.0, then 5.2, and 4.3. These are huge errors. Okay, so I use their papers a lot. I have to say, their research. I'm not speaking from prejudice here. I would like to see them preserved as a research institution. It's just this is one problem with their forecasting that would have to be corrected. Their economic policies have in general failed. This is, of course, a very hard thing to prove overall, econometrically. So one thing that we did was just, well, here's Latin America. You can look at that. A heavily influenced IMF region since the 1980s. That's the graph I always show for, whenever we talk about Latin America. They grew from 82% per capita from 1960 to 1980. And since then, again, the period when the IMF had the most influence on policy overwhelmingly, it's been slow, very slow economic growth. Only 9% per capita from 80 to 2000. This decade has picked up quite a bit, especially the last few years, but still not going to be anything like one of the previous decades. And this is the growth they're raving about in the business price. The bar has become so low. They forget that developing countries normally grow faster than rich countries. This growth that they had, in the 60s and 70s was not phenomenal. It was only about half, or less than half, of what South Korea and Taiwan did during the same period, but it was normal growth. So hopefully this era is coming to an end, and there's been a whole series of elections in at least 10 countries where voters rejected this set of policies and have been pushing for alternatives. The slowdown in economic, another way to just look at the policies that the IMF has been promoting since 1980 is just to look at the whole world. And I don't want to go on too long here, so I'll just briefly say this is 163 countries divided into quintiles by their income levels. And you can see there were big declines, except for the lowest one, the very lowest quintile. But that's India and China and Vietnam. If you take that out, there's nothing to brag about there either. And in fact, it's still pretty bad growth at 1.7% annually. So they can't really, again, you can't blame the IMF for all this, but I would like to see the IMF come back and say, why is it? They really have to answer this question because nobody's put enough pressure on it. Why has the world economy done so badly, developing countries, I should say, since 1980? It's a long time now. You can't blame it anymore on just the debt pile up from the 70s, like you used to say. They should really, since they were involved in decision making in dozens of developing countries, heavily involved, they should be able to tell us, is this just something that, is this an act of God? Is there some reason for this? And I haven't heard it yet. The IMF has been a champion of the deregulated global finance flows that played a huge role in the current mess. And they did that, in fact, in the Asian crisis. That was one of the causes of the Asian financial crisis. I would say the primary cause was the deregulated finance that the IMF and Treasury together pushed on countries like South Korea and Indonesia, got them to remove a lot of their restrictions on both financial and non-financial corporations, restrictions on foreign borrowing, regulation of foreign borrowing that they had. And it was that hot money flow that went in and then out that really played the biggest role in creating that mess. And of course, they have supported the kind of globalization of finance that has contributed to the mess that we're looking at today. And at the end of the Asian crisis, they actually wanted to change their, that was the beginning of the crisis, they changed that. They wanted to change their charter so that they could actually pressure countries to open up to capital inflows. So, what's number one? I know the suspense is killing you. The IMF is run mostly by the U.S. Treasury Department. There he is. 164 million at the peak of the housing bubble while Goldman Sachs was being run to the ground with the financial sector going down with it. And by the way, the fact that the U.S. Treasury mostly runs the IMF is not really a matter of dispute here in Washington. I mean, if you talk to the IMF officially, they'll tell you that there are 185 member organizations, et cetera, et cetera. But as I said, the U.S. influence is much, much greater than even the formal veto power that they have. Do I have a couple minutes still? Yeah, I think I will. All right. I want to make a couple of points because after the Asian crisis especially, there was a lot of talk about a new financial architecture. There were books written and policies proposed, and some of them were good ideas, a world currency, a world central bank, all kinds of things that seemed kind of utopian perhaps, but they were taken seriously at the time because at that time that was a pretty serious crisis. They didn't know what was coming. And so what happened 10 years later? Nothing, right? Did you see anything happen? Has there been a change in the financial architecture? No. In fact, it got worse, right? The U.S. Financial sector managed to come up with toxic securities that caused trouble all over the world. And so it didn't happen. And I would argue that it's not going to happen. And that we shouldn't, it's fine with me if people want to talk about it. I'm all for vision. But I think we should also try to be realistic. And I think there's a fundamental misunderstanding of the world economy that leads people to think that these problems are going to be resolved at the global level. That is that the rich countries, and now, as Oleg says, we got to get some of our favorite developing countries into the G8, so that it's not just the rich countries. That there's going to be a formal organization like the IMF, or something perhaps to be created that's going to resolve these problems. I don't think it's going to happen. I think it's a misunderstanding of the economy. I don't think we really have a global economy. I think we have a collection of national economies still, even today. And the vast majority of what's produced in the world is still consumed locally. And finance is even still, despite all the changes, even more national than international. And so it's going to be national solutions and regional ones like the Chiang Mai Initiative in Asia, for example. And they're talking about regional solutions in Latin America now. And the reason is this, okay? These people haven't changed. I'm sorry to say, they were very flexible in the latest response to the crisis here, and I'm glad that they were, and I hope they continue to show flexibility, even if they did have that horrible bailout thing for their friends. The other measures that we've mentioned were the important and necessary ones, and there's going to be a lot more that are necessary. But when it comes to the developing world, the rich countries just don't have their interests at heart. And that's one reason why you wouldn't want not only the IMF, but something else to be the dominant institution here. So I think you will see more coordination. I hope you'll see more coordination. The G7, obviously the interest rate cuts, coordinating that was a very positive step. Maybe they'll have coordination on exchange rate policy. We could always hope for that. But the idea of a new system coming out of this isn't going to happen. And national policy, and I just want to emphasize how important it is. Look at China during the Asian financial crisis. They were the only one of those countries that didn't suffer, that didn't drop, have a big GDP loss. They continued growing quite rapidly. Why? They changed their policies, their macroeconomic policies, and their overall economic policies completely. They focused on inward-oriented growth during that period. They did not get into competitive devaluations and try to get out of the crisis the way the other countries did, and they didn't have the IMF telling them what to do. So individual macro policy is going to be extremely important. I would like to see it coordinated with the United States. What the United States does with its own macro policy, if they can be as flexible on fiscal policy and get rid of the dogma the way they just have in terms of the nationalizing these major institutions and intervening in the banking system, then we have a chance at mitigating, the damage of this recession. But individual countries are going to have to do that and coordinate as much as possible. I don't think it's going to come from any kind of new financial architecture in the foreseeable future. Thanks.